Hello everyone, welcome to the 42nd episode of me learning how to trade using Forex. So in the last episode we went through why trade Forex versus futures. We made some notes regarding all of this, took the quiz, done the quiz, and now we're currently on what is margin trading. So yeah, let's get started. What is margin trading? The biggest appeal that Forex trading offers is the ability to trade on margin. But for many Forex traders, margin is a foreign concept and one that is often misunderstood, like Bob. Very nice, Bob. Bob sure knows his fried chicken and mashed potatoes, but absolutely has no clue about margin leverage. Margin trading gives you the ability to enter into positions larger than your account balance. With a bit of cash, you can open up a much bigger trade in the Forex market. And then with just a small change in price moving in your favour, you have the possibility of ending up with massively huge profits. But for most new traders, because they usually don't know what they're doing, that's not what usually happens. More likely, prices does move, but it moves against them, like what happened to Bob. Bob was in a trade. He was sure that this trade was going to be a winner, so he bet big. All of a sudden, to Bob's surprise and shock, he witnessed his trade being automatically closed on his trading platform, ended up suffering an epic loss. The funds that now remain Bob's account aren't even enough to open another trade. Bob is confused. He asks himself, WTF just happened? What's happened to my account? He contacted his Forex broker and is told that he had been sent a margin call and experienced a stop out. Bob doesn't know what the broker is talking about. Bob is clueless. This is why understanding how margin works is essential. A lot of new traders do not understand the concept of margin, how it's used, how to calculate it, and the significance that it plays in their trading. Do you know what margin actually is? What about used margin? What is free margin? What is margin level? What is a margin call? What is a stop out or margin closeout? As you can see, there is a lot of margin jargon used in Forex trading. Before you choose a Forex broker and begin trading with margin, it's important to understand what all this margin jargon means. If you don't, it's almost guaranteed that you'll end up like Bob. Terrible things will happen to your trading account, like a margin call or a margin stop out, but you won't even know what just happened or even why it happens. If you really want to understand how margin is used in Forex trading, you need to know how your margin trading account really works. This starts with understanding what the heck some really important numbers you see on a trading platform really mean. We call these numbers your margin account's metrics. For example, take a look at MetaTrader 4, also known as MT4 trading platform. The metrics above are all intertwined. A change in one causes change in another. So they highlighted balance €1,000, equity 1,000, margin 500, free margin 500, margin level 200%. A change in one causes, so we got balance, got this, equity that, margin levels that, free margin, margin levels that, I'm guessing this is margin, free margin, margin level, unrealized, PL, what does PL mean? As a trader, you'll need to be aware of the relationships between them before ever entering a single trade on a live account. Don't be like Bob. I'm not Bob. When certain metrics fall below a certain value, bad things will happen. So you need to know what these metrics are. You also need to know what these bad things are. Make sure you have a solid grasp on how your trading account actually works and how it uses margin. So let's dive right in. A margin trading account displays the following metrics. So, a margin, oh that's the wrong way to spell it. A margin trading account displays the following metrics. Balance, used margin, free margin, unrealized P/L, equity, and margin level. A metric is just a measurement of something. This means that every metric above measures something important about your account involving margin. For example, the balance measures how much cash you have in your account, and if you don't have a certain amount of cash, you may not have enough margin to open new trades or keep existing trades open. Depending on the trading platform, each metric might have slightly different names, but what's being measured is the same. Let's take another look at the metrics on MetaTrader 4. You'll notice that it looks like that used margin is not displayed, but it's there. MetaTrader 4 just displays it as margin. Ah, right, okay, so margin, that's used margin, free margin, margin level, and what's unrealized PL. MetaTrader, why you do this? Here's another example of account metrics from a different Forex trading platform. Same metrics as MetaTrader 4 but different labels. So we've got available to trade, net equity, cash, I'm guessing that's balance. Available to trade, I'm guessing that's free margin. Available to trade, net equity is equity. Unrealized P&L, total margin, is that free margin? And margin indicator, is that margin level then, I'm guessing. Don't worry about different labels right now. We're explaining each margin related metric in a way that you'll be able to know which metric is which regardless of the exact label. We'll also let you know what other names that a specific metric is also known by. And at the end of this margin trading 101 course, we'll provide a useful cheat sheet for all this margin jargon. Let's now discuss each metric one by one in detail. We'll start with an easy one. That's balance, I'm guessing. What is account balance? Yep. What does account balance mean? In order to start trading Forex, you need to open an account with retail Forex broker or with a retail Forex broker or CFD provider. Once your account is approved, then you can transfer funds into the account. This new account should only be funded with risk capital, which is cash you can afford to lose. I need me some risk capital. The account balance, or simply balance, is the starting balance of your account. Basically, it's the amount of cash in your account. Think of it this way, balance equals cash. So, amount of cash you can afford to lose in your account. Your balance measures the amount of cash you have in your trading account. If you deposit 1,000, then your balance is 1,000. Balance before deposit 0, balance after deposit 1,000. If you enter a new trade or in trader lingo, open a new position, your balance account is not affected until the position is closed. This means that your balance will only change one of the three ways: when you add more funds, when you close a position, when you keep a position open overnight, either receive or pay swap/rollover fee. Your balance can change in three ways: when adding more funds to the account, when closing trades, when you close a position, when closing a position, when you keep a position open overnight, and either receive or pay swap/roll over fee. Since the topic is about margin, the concepts of swap and rollover aren't really related, but for thoroughness, we'll quickly describe it since swap fees do affect your balance. Just know that there's a difference between the trade that lasts a couple of hours and the trade you keep open overnight. Day 1, day 2 open position. Day 1, day 2 swap fee, debit or credit, rollover. This procedure of moving open positions from one trading day to another is called a rollover. When moving open positions from one trading day to another. Most brokers perform the rollover automatically by closing any open positions at the end of the day, while simultaneously opening an identical position of the following business day. During this rollover, a swap is calculated. A swap is a fee that is either paid or charged to you at the end of each trading day if you keep your trade open overnight. If you are paid swap, cash will be added to your balance. If you are charged swap, cash will be deducted from your balance. Unless you're trading huge position sizes, these swap fees are usually small but can add up over time. In MetaTrader, you can see swaps on your open position if you keep it open for longer than one day by opening a terminal window and clicking on the Trade tab. So swap fees here. The concept of swap and rollover is beyond the scope of this lesson and will not be discussed further, but we just wanted to cover it briefly for accuracy's sake. Now that we know what balance means, let's move on to understanding the concepts of unrealized PL and realized PL and how they affect your balance. What is unrealized PL and floating PL? In your trading platform, you will see something that says unrealized PL or floating PL with green or red numbers beside them. So, unrealized PL. With a green or red numbers beside them. This is more like has a green or red. In this lesson, we explain what unrealized PL and floating PL are. When trading, there are actually two types of profit or loss, also known as PL. Oh, right, okay, so PL stands for profit or loss. Both are important. Let's discuss the difference between the two. Unrealized. Let's go. Profit/loss. There's a green or red number beside them. Unrealized PL refers to the profit or loss held in your current open positions, your currently active trades. So it refers to the profit or loss held in your account in your current open positions. Your currently active trades. This is equal to the profit or loss that would be realized if all your open positions were closed immediately. Equal to the profit or loss that would be realized if all your open positions were closed immediately. Equal to the profit or loss that if all your open were closed immediately. Unrealized PL is also known as floating PL. Also known as floating profit or loss, because the value is constantly changing since your positions are open. As the value is constantly changing since your positions are open. Your unrealized PL continuously fluctuates or floats with the current market prices if you have open positions. For example, if you currently have an unrealized profit, if the price moves against you, the unrealized profit can become an unrealized loss. Example, floating losses. Example, floating loss. Let's say your account is in US dollars and you're currently long, so buying 10,000 units of Euro USD, which was bought at 1.15000. The current exchange rate for Euro USD is 1.13000. Let's calculate the position's floating PL, profit or loss. Floating profit or loss equals position size times my current price minus entry price. So 10,000 times 1.13 minus 1.15 minus 200 equals basically 10,000 times minus 0.02 equals minus 200. The position is down 200 pips. Since you're trading a mini lot, each pip was worth $1, so you currently have a floating loss of $200. It is a floating loss because you have not closed the trade yet. Usually when a loss remains floating, you are hoping that the price will turn around. If Euro USD rose above your original entry price to 1.16, then you would now have a floating profit. The position is now up 100 pips. Since you're trading a mini lot, each pip is worth $1, so you currently have a floating profit of $100. Realized PL. A realized profit is a profit that comes from a complete trade. This is a floating loss. Same thing with a loss. A realized loss is a loss that comes from a completed trade. In other words, your profit or losses only become realized when the positions are closed. This is the only time when your account balance will change to reflect any gains or losses. If you close a position with profit, your account balance will increase. If you close with losses, then your account balance will decrease. Profit slash loss. The profit slash loss, which comes with a completed trade or a closed position. Slash a closed position. This is the only time when your account balance will change to reflect any gains or losses. This is the only time when your account balance will change to reflect any gains or losses. Example, realized loss. Let's say your account is in USD and you're currently long 10,000 units of Euro USD, which is bought at 1.15. The current exchange rate is 1.13. So let's calculate positions. Floating PL, so minus 200. Calculate that before. It's floating because you have not closed the trade yet, but you can't stomach losing anymore and decide to close the trade right then and there. You've realized the $200 loss and the cash is deducted from your account balance. When you open the trade, you had 1,000 as your balance, but after you close the trade with a $200 loss, your account is now 800. Example, realized profit. Do the same thing. The position is up 100 pips, and since you're trading a mini lot, it should be at $100. You hear a voice out of nowhere to exit your trade, so you close the trade. You realize the $100 dollar gain, and the cash is added to your account balance. When you open the trade, you had 1,000 as your balance, but after you close the trade with $100 gain, your balance is now 1,100. Profit isn't real until it's realized. The difference between realized and unrealized profit is subtle, but it can mean the difference between a profitable trade or a losing trade. It's important for traders to clearly know how to differentiate between realized profit loss and unrealized profit loss. Realized profits are gains that have been converted to cash and added to your account balance. Realized losses are losses that have been converted to cash and deducted from your account balance. In other words, for you to realize profits from a trade you've made, you must receive cash and not simply observe the value of your trade increase without exiting the trade. Unrealized profit is theoretical profit or paper profit that is currently available but could be taken away at any moment if the price moves against the trade. When it comes to love, think about the one that got away. At one point in life, he or she was an unrealized spouse. Oof. You never built up the courage to pop the question, now you're forever heartbroken with realized loss of the perfect spouse. This is exactly what happened to Bob. Jesus, Bob is getting bullied here, you know. To this day, Bob is still single. This depressing life lesson from Bob's sad love story can be applied to trading. If you have not closed out your position and realized your gain, you could still lose some or all of your profits. Realized profit is real profit that can no longer be affected by price changes because it is no longer part of an active trade. It is real money that is added to your balance and can be withdrawn from your trading account and transferred into your bank account. Recap. In this lesson we learnt about the following. Unrealized profit loss or floating profit loss refers to the profit or loss held in your current open positions, your currently active trades. Realized profit loss refers to the profit or loss gained from a complete trade. In previous lessons we've learnt what is margin trading, learn why it's important to understand how your margin count works, what is balance, your account balance is the cash you have available in your trading account. Let's move on and learn about the concept of margin. What is margin? Oh, hold on. What about the others? The used margin, free margin, equity, margin level. What about these? We haven't gone through yet. Okay, what is margin? What is margin? When trading Forex, you are only required to put a small amount of capital to open and maintain a new position. This capital is known as the margin. For example, you want to buy 100,000 worth of USD JPY. You don't need to put up a full amount, you only need to put up a portion, like 3,000. The actual amount depends on your Forex broker or CFD provider. Margin can be thought of as a good faith deposit or collateral that's needed to open a position and keep it open. It is a good faith assurance that you can afford to hold a trade until it is closed. Margin is not a fee or a transaction cost. Margin is simply a portion of your funds that your Forex broker sets aside from your account balance to keep your trade open and ensure that you can cover the potential loss of the trade. The position is used or locked up for the duration. This portion is used or locked up for the portion of the specific trade. Once the trade is closed, the margin is freed or released back into your account and it can now be usable again to open new trades. What is the margin requirements? Margin expressed as a percentage of the full position size, also known as the notion value of the position you wish to open. So, margin is expressed as a, what was that, percentage of the full position size, also known as the notional value of the position you wish to open. Depending on the currency pair and Forex broker, the amount of margin required to open a position varies. You may see margin requirements such as 0.25%, 0.5%, 1%, 2%, 5%, 10% or higher. This percentage is known as the margin requirement. Here are some examples of margin requirements for several currency pairs. 2% for EUR/USD, 5% for GBP/USD, 4% for USD/JPY, and 3% for EUR/AUD. What is required margin? When margin is expressed as a specific amount of your account's currency, this amount is known as a required margin. What? What's that? Okay. So required margin is expressed as a specific amount of your account's, what is good, accounts currency. Each position you open will have its own required margin amount that will need to be locked up. Required margin is also known as deposit margin, entry margin, or initial margin. Required margin deposit margin, entry margin, initial margin. Let's look at a typical Euro USD, Euro against US dollar trade. To buy or sell 100,000 of Euro USD without leverage will require the trader to put up 100,000 in account funds, the full value of the position. But with a margin requirement of 2%, only 2,000, the required margin of the trader's funds will be required to open and maintain that 100,000 Euro USD position. Trade size 100,000, 10,000, 1,000. Example, open a long USD JPY position. Let's say if you deposit 1,000 in your account and want to go long USD JPY and want to open one mini lot, 10,000 units of position. How much margin will we need to open this position? Since USD is a base currency, this mini lot is $110,000, which means that the position's notional value is 10,000. Assuming your trading account is denominated in USD, since the margin requirement is 4%, required margin would be 400. Because %4 of 10,000 is 400. Yeah. Yeah, that's right. Example 2. Open a long GBP/USD position. Let's say you deposit 1,000 in your account. I want to go long GBP USD at 1.3. I want to open one mini lot, 10,000 units of position. How much margin will we need to open the position? Since GBP is a base currency, this mini lot is £10,000, which means the position's notional value is $13,000. Dollars, not euros. Assuming your trading account is denominated in USD, since the margin requirement is 5%, the required margin will be 650. Okay. Open a long EUR AUD position. Let's say you want to go long Euro AUD and want to open one mini lot, 10,000 units position. How much margin will you need to open this position? Assuming your trading account is denominated in USD, you need to first know what the Euro USD price. Let's say EUR USD is trading at 1.15000. Since EUR USD is a base currency, this mini lot is 10,000 euros, which means the position's notional value is 11,500. Since the margin requirement is 3%, the required margin would be $345. How to calculate required margin? When trading with margin, the amount of margin or required margin needed to hold open a position is calculated as a percentage of the position size. So you got required margin and margin requirement. So for margin, the amount of margin or the required margin is the needed to hold open a position is calculated as a percentage margin requirement of the position size, notional value. The specific amount of required margin is calculated according to the base currency of the currency pair traded. If the base currency is different from your trading account's currency, the required margin is then converted to your account denomination. So the specific amount of required margin is calculated according to the base currency of the currency pair traded. If the base currency is different from your trading account's currency, the required margin is then converted to your account denomination. Here is the formula to calculate the required margin. If the base currency is the same as your account's currency, required margin equals notional value times margin requirements. If the base currency is different from your account's currency, required margin equals notional value times margin requirement times the exchange rate between base currency and account currency. Okay, it's just an exchange rate. The only reason for having funds in your account is to make sure you have enough margin to use for trading. When it comes to trading Forex, your ability to open trades is not necessarily based on the funds in your account balance. More accurately, it's based on the amount of margin you have. This means that your broker is always looking to see if you have enough margin in your account, which can actually differ from your account balance. If this sounds confusing, don't worry. It will start making more sense as we proceed. Recap. In this lesson, so it differs from your account balance. Okay. In this lesson, we learned about the following. Margin requirement is the amount of margin required to open a position. It is expressed as a percentage of the full position size or notional value of the position you wish to open. Required margin is the amount of money that is set aside and locked up when you open a position. In previous lessons, we've learnt what is margin trading, learn why it's important to understand how your margin account works, what is balance. Your account balance is the cash you have available in your trading account. What is unrealized and realized profit loss, knowing how profit loss affects your account balance. Let's move on and learn about the concept of used margin. What is used margin? What does used margin mean? In order to understand what used margin is, we must first understand what required margin is. Whenever you open up a new position, a specific amount of required margin is set aside. Required margin was discussed in detail in the previous lesson, so if you don't know what it is, please read our what is margin lesson first. If you open more than one position at a time, each specific position will have its own required margin. So required margin, remember, is the amount of margin needed to hold open a position. If you add up all the required margin for the positions that open, the total amount is what's called the used margin. Used margin. Right, okay, so. When all the required margin is added up, margin of all the positions that are open is added up. Total amount is what's called a used margin. Used margin is all the margin that's locked up and can't be used to open new positions. This is all the margin which is locked up and can't be used to open new positions. This margin is already being used, hence the name used margin. Whilst required margin is tied to a specific trade, used margin refers to the amount of money you needed to deposit to keep all your trades open. Example 1. Open a long USD JPY and USD CHF position. Let's say you've deposited the files in your account and want to open 2 positions. Long USD JPY and want to open 1 mini lot 10,000 units position. Long USD CHF and want to open 1 mini lot 10,000 units position. The margin requirements for each currency pair is as follows. So USD JPY is 4% margin, USD CHF is 3%. How much required margin will you need to open each position? Since USD is a base currency for both currency pairs, a mini lot is $10,000, which means each position's notional value is 10,000. Let's now calculate the required margin for each position. JUSD/JPY position. The used margin for USD/JPY is 4%. Assuming your trading account is denominated in USD, the required margin will be $400 because it's 4% times stuff like that, 10,000. Yep. USD is at 3%, so that's $300 then. Yep. Because it's 10,000 times nominal 3%. Since you have 2 trades, the used margin in your trading account will be 700, which because it's 400 plus 300, isn't it? Yep. Here's a cool diagram of how used margin relates to the required margin and balance. Required margin of that is 400, required margin of USD CHF is 300, used margin, you add them up together, your balance is 1,000. So you got $300 to play with basically. In this lesson we learnt about the following. Used margin is the total amount of margin currently used to maintain all open positions. Said differently, it is a sum of all required margin being used. In previous lesson we learnt what is margin trading, learn why it's important to understand how your margin account works. What is balance? Your account balance is the cash you have available in your trading accounts. What is unrealized and realized profit loss? Know how profit loss affects your account balance. What is margin? Required margin is the amount of money that is set aside to locked up when you open a position. Let's move on and learn about the concept of equity. What is equity? What does equity mean? The account equity, or simply equity, represents the current value of your trading accounts. So equity is the current value of your trading account. Equity is the current value of the account and fluctuates with every tick when looking at your trading platform on your screen, because the market changes every second, doesn't it? So the price changes every second, so your account value also changes every second. It is a sum of your account balance and all floating unrealized profit or losses associated with your open positions. So the sum of your account balance and all floating profits or losses associated with your open positions. As your current trades rise or fall in value, so does your equity. How to calculate equity if no trades open? If you do not have any open positions, then your equity is the same as your balance. Yep. Example, account equity when you have no open trades. You deposit 1,000 in your trading account. Since you haven't opened any trades yet, your balance and equity is the same. How to calculate equity if trades open? If you have open positions, your equity is the sum of your account balance and your account's floating PL. Example, account equity when an existing trade is losing. You deposit $1,000 in your $1,000 in your trading accounts. Beyonce tweets she's shorting GBP USD. Because she's Beyonce, you follow that, what she says, and go short also. Price moves immediately against you and your trade shows a floating loss of $50. The equity in your account is now 950 because you lost up. You got a unrealized loss of $50. Example, account equity when an existing trade is winning. Beyonce tweets again and says she's changed her mind. She's now long GBP USD. Not only is she crazy in love, but she seems crazy in trading also. But because she's the queen bee, you follow what she says and goes long also. Price moves immediately in favor and your trade shows a floating gain of $100. The equity in your account is now 1,100. Your account equity continually fluctuates with the current market prices as long as you have any open positions. Equity shows the temporary value of account at the current time, unlike a tattoo which is not temporary. Shows the temporary value of your account at the current time. That's why equity is seen as a floating account balance. It would only become your real account balance if you had to close your trades immediately. What is the difference between balance and equity? Let's start with a simple answer. Wait, this is before I read this, isn't balance is realized, whereas equity is still like unrealized basically, because equity takes into account the floating or unrealized profit losses, whereas balance is your account after your trades, all your trades have been closed. Let's start with a simple answer. If your account is flat or does not have any positions open, then your balance and equity are the same. But if you do have open positions, this is when the balance and equity differ. The balance reflects your profit loss from closed positions. The equity reflects a real-time calculation of your profit/loss. The equity takes into account both open and closed positions. Closed positions. Closed position basically the balance. This means that when you're looking at your balance, it is not the actual real-time amount of your funds. Since equity includes current profit or losses from open trades, it is equity that shows the real-time amount of your funds. Since equity, real time, it is possible to have very large balance but very small equity. This happens when your open positions have a large unrealized floating losses. For example, if your balance is 1,000 and you have an open trade that's a floating loss of 900, your equity is only 100. Right, okay, so shows the real-time amount. Recap. In this lesson we learnt about the following. Equity is your account balance plus the floating profit or loss of all your open positions. Equity represents the real-time value of your account. In previous lessons we've learnt what is margin trading, learn why it's important, understand how your margin account works. What is balance? Your account balance is the cash you have available in your trading account. What is unrealized profit/loss? Know how profit or losses affect your account balance. What is margin? Required margin is the amount of money that is set aside and locked up when you open a position. What is used margin? Used margin is the total amount of margin that is currently locked up to maintain all open positions. Let's move on and learn about the concept of free margin. I am going to leave this episode here. Thank you guys for watching. In the next video we're going to go through what is free margin and make some notes on that. So yeah, thank you guys for watching and I'll see you guys in the next video. Peace.